Boom. How long do I have to wait to withdraw money from my policy? Not as long as you think, not as long as you were told. Check out the rest of this video. We'll get into the full details of exactly what it looks like, and it will put a smile on your face. So listen, we're talking about how long do I have to wait to withdraw money from my policy, which I'll get into at the end of this video. What I want to pivot to first is the benefits of a cash value policy and what that actually looks like as far as mechanically getting it off the ground. As you put money into the policy and you want to borrow from it, they're not going to run your credit. You don't need anyone's permission, and you could use the money for whatever you want, whether it's buying a piece of real estate, whether it's going on a European vacation, or whatever the case be. This is your money that you've built up and you have complete access to it. And the greatest part of it is, yes, you borrow money at an interest rate, so the interest is due. You get to decide how you're going to pay the principal back on what time frame, whether it's 1 year, 3, 5, or 10 years, totally your choice. Or you may just pay the interest on the loan and never pay back the principal. And when you do shuffle off this mortal coil, the death benefit will go to your heirs minus the money you borrowed from yourself. However, if you've done it the right way, when you borrowed money, you put it into another asset, so that's there as well. So now we're going to get into the mechanics of funding. But before I talk about this, I want to tell you one quick 30-second story. There was a gentleman that became a client that didn't even make his first payment and asked if he could borrow from his death benefit. That's somebody that was misinformed, right? Or didn't understand the mechanics. So we want to go slow so you totally get it. When it comes to funding a policy, I look at two different things simultaneously happening at the same time. One is, what is your baseline premium, which we tie into what is your monthly savings goal? The other is what we like to call the dump-in or the splash unscheduled contribution. For example, let's say if somebody is going to save $2,000 a month as a baseline premium, but they have approximately $50,000 that they want to dump in. Now, I'm using the number 50 because that would be probably the ceiling, and this is based on gender, age, and policy design, but that would be the ceiling of what somebody could dump in this scenario without creating a taxable event. So now, if you're paying $2,000 a month and you're in the first month, and at the end of the month you dump in $50,000, well, depending on the carrier, whether it's 21 or 30 days, that $50,000 you would have access to borrow from yourself and put it into another investment opportunity. What some folks do that love real estate, they'll start the policy because they have 100 grand saved up and they're going to save 3, 4, 5,000 a month. They want to use that 100 as a down payment for their piece of real estate. So they'll start the policy knowing it's a long-term play. This isn't short-term. This isn't overnight for 12 months and let me stop. It's a long-term plan, but they want to be able to get the multiple uses of that 100 grand. So they'll dump it in, take it out within 21 to 30 days, put it as a down payment on their piece of real estate, get 4 rates of return on the real estate and have the renter pay back the policy. That's a scenario, if you are professional, I-dotting and T-crossing and understand the game of real estate, that a lot of folks utilize when it comes to the insurance strategy, understanding that this is a long-term strategy, not a short-term strategy. So folks, check it out. I just gave a quick example in the previous part of this video. If somebody's gonna do a baseline savings, that's their monthly premium of $2,000 a month, and I'm giving, guesstimated terms, if they were to dump in 50 grand, that would allow them to access the money. That same person in that same scenario could dump in 500 grand, but the challenge is it becomes a modified endowment contract. In English, that means that policy now becomes taxed at ordinary income. So whenever you're working with your insurance professional, these are conversations that are important. Not only what your baseline savings is, premium, but how much you plan on unscheduled dumping in. Do you want to dump that money in all at once? Do you want to dump it in within the first year over a couple of years? But with that being said and done, the definition of a modified endowment contract, and well, this isn't the definition, but if you look at what the Rockefellers did, they stored enormous amounts of money inside protected life insurance policies to protect it from being taxed, and a lot of people did that. And because of this and what other wealthy individuals did, in 1986, the government came and changed the tax law because a lot of folks were not only getting interest rates at that point like 19 or 20%, so they would take these baseline policies, save $1,000 a month and try and dump in $1 million. And I'm giving guesstimated numbers, but because of that, the government changed the game. Now, there was a little bit of a jab back, a response. Yeah, you can see I got movement. You guys didn't know about that. Bang. And what happened is in December 31st, 2021, The insurance industry threw a jab back and created the Rule 7702, which gives more of that dump and flexibility that hasn't existed since 1986. All right, so folks, check it out. When we talk about the 7702, it wasn't created, it's been around for a long time, but there's been a little change in distinction, which has created more flexibility on a dump-in. But why MECs aren't desirable? People don't want to pay taxes. Think about it. Do you want to pay taxes, especially ordinary income taxes? So at the end of the day, any loans, and here's the science or the legal language behind what this looks like, any loans or withdrawals from a MEC are taxed on the last in, first out basis instead of FIFO, which is first in, first out. Therefore, any taxable gain that comes out of the contract is reported before the non-taxable return of the principal, blah, 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 blah. Furthermore, policy owners under the age of 59.5 must pay a 10% penalty of early withdrawals. It sounds a lot like a 401k or an IRA right now. It should also be noted that the IRS has its own set of guideline premiums that must be met in order for the cash value policies to retain their FIFO status. Let me just break it down. Once it becomes a MEC, it's always a MEC, and anything above basis is going to get taxed at ordinary income. And if you're 59.5 or below, or 59.4 and below, you're also going to get that 10% penalty. So it's important to have these educated conversations with not only your fiduciary, which I am not a fiduciary, your insurance agent, fiduciary, accountant, trust officer, and everybody else that's financially involved in your world, so your decisions are clear, you understand it not only today, but how your thought process could be impacted 5, 10, and 15 years down the road. All right, folks, so we talked about funding, and then we also talked about the unscheduled dump-ins. Now, how do you have access to that money? What do you have to do, and what is the time frame? And the way it works is, whenever you have your dump-in, and it depends on carrier, but the minimum time is about 21 days from when you dump the money in. So for example, you know, your baseline saving is $2,000 a month and you dump in on, let's say, February 1st, $50,000. On February 22nd, you will now have access and the ability to leverage off that money. The reason why there is a delay on the dump it is only because of anti-money laundering. They want to make sure the money's clean, the checks don't bounce, and it clears each side, so everything is copacetic. So listen, the top of this video was how do I borrow money for my policy? And we went through the mechanics of monthly savings, AKA premium, unscheduled dump-ins, how to avoid it to become taxable. Now we're at the stage where borrowing against my policy. Once you've overfunded your policy and waited the minimum 21-day period, it'll take about 3 to 5 business days to get the loan into your bank account. Beyond the extra interest your money is earning, this strategy gives you more flexibility than borrowing from a bank and prevents hard credit pulls. In other words, you're borrowing your own money. They're not going to run your credit. You know, typically it takes 3 to 5 days, closer to 3 days. And at the end of the day, if you have a close relationship with your agent and you guys or gals are always on the same page, this will be something that you do systematically, and it'll be done very easily, and the money will be wired into your account. Okay, so I just took you through a really good journey and gave really good examples of what this looks like. Go ahead and click that link below. The team members here are going to take you through the process on exactly what it looks like, the time frame, and how to execute on a high level. And at the end of the day, give you exactly what you're looking for when it comes to being able to get multiple uses of your money within the same time frame of a month. You don't have to wait 2 or 3 years to build up your policy to be able to access that money. We just gave you the roadmap on how to do it very quickly. So once again, go ahead, click that link below. Our team members will get back to you and share with you the secret sauce on how we do it at a high level. So listen, in the last approximate 10 minutes, we just gave you some valuable information that can help you make some really good decisions with your money. Thank you for watching the video, by the way, and taking the time to be on it even this long. Go ahead and hit that subscribe button. Every day we're dropping new content. We're bringing out information that can help you make good decisions when it comes to your money. And if you thought this video was AKA dynamite, wait till you see this next video.